Well, the latest minutes from the Reserve Bank reveal this month's shock interest rate cut was a very close call. Falling prices forced the RBA's hand, albeit reluctantly. But one board member has signalled to the ABC that there's still room for more cuts. Here's finance correspondent Philip Lasker.
Interest rates and underlying inflation at record lows is not a comforting sight for everyone.
But that in itself is really the tip of the iceberg.
For David Llewellyn-Smith, it reflects a weak economy whose income has been undermined by falling commodity prices, companies facing increased competition with diminishing pricing power, and employees whose pay barely keeps pace with minuscule inflation.
The RBA, therefore, is confronting quite slack growth, quite slack domestic demand, and that is what is driving lower inflation.
But the Reserve Bank is at pains to point out that the rate cut does not mean the economy's in trouble. The minutes of this month's meeting stated the outlook for jobs and the economy hasn't changed much over the past 3 months, and the shock decision to cut was a close-run thing.
In the Reserve Bank's forecast, that is, we have 1.5% inflation for the rest of this year. We move up to 2% next year. That's not actually a bad outlook. It's not that it's a problem, it's an opportunity.
An opportunity to enjoy lower interest rates without worrying about a wages breakout, and possibly, suggests the Reserve Bank board member, an opportunity to enjoy even lower rates.
Of course, it means that if our forecasts for inflation are 0.5% lower than they were, then the after-inflation interest rate that we had targeted is 0.5% higher than we thought it was. So it's an opportunity. It's not, I think, telling us that we're in dire trouble in this economy.
Does that mean the cash rate can come down another 25 basis points?
I wouldn't care to speculate.
To those like investment banks Goldman Sachs and Morgan Stanley, these rate cuts and more make perfect sense because they believe the worst of the transition from mining isn't over. They're concerned about a slowdown in construction and they're not impressed by the jobs market or domestic spending. The Commonwealth Bank's Michael Blythe isn't in that camp, even though he's come to the more bearish view that the RBA will cut twice before Christmas.
The real economy, I don't think, really needs any extra assistance right now. I think what we're really saying here is in the absence of anything else coming along to do some of the heavy lifting for policy, then what's left? It's all down to interest rates.
That's a frightening thought, given the Reserve Bank Governor's comments in New York last month.
It's undeniable, I think, that monetary policy alone hasn't been and isn't able to generate sustained growth, at least not to the extent that people want.
It's the conundrum that many central banks are facing right now. What we're seeing is that labour markets are improving, but it's not flowing through to wages. Because wages are pretty subdued, inflation rates are low, and that's seeing inflation expectations move lower. And that can make the job for monetary policy a lot more complicated. Our central bank wants to get ahead of that and make sure that we're not going down the same path as we're seeing elsewhere.
John Edwards says the downgrade in the Reserve Bank's inflation forecast comes from the domestic economy and weaker than expected wages growth.
You might say, well, this is a problem, but it's being offset to a very large extent by a much higher rate of employment growth than the Reserve Bank had expected.
The RBA has even turned a blind eye to the risk of further fuelling the property market by cutting interest rates.
The Reserve Bank's looked at that. They've decided that inflation issue is a bigger risk.
The RBA is counting on regulators to keep the banks and property prices at bay, while rate cuts are aimed at averting a disaster for debt-laden households, a property price collapse triggered by mortgage stress.
If you let inflation get too low, then your real interest rate starts to rise and the debt burden becomes a problem.
Glenn Stevens steps down in September, but the effect of his decisions will live on.